What's up everybody, I am Jaspreet Singh, and if you are in the market for a home right now, not only do you have to compete against a whole bunch of other people that want to buy a home, but you're also competing against investors who have cash, who are buying homes without a mortgage, and you're also competing against corporations and hedge funds that are buying up properties for their investment portfolio. There's a lot of concerns about what's going on right now. The first concern being, why am I recording this video here sitting down? And that's because, well, the rest of my office is having some electrical issues, so we're getting that taken care of. The second concern is what's going to happen to the housing market. The first major concern in the housing market goes back to March 27, 2020, when President Donald Trump signed the CARES Act, which provided some relief to homeowners. The economy was shut down, so nobody's working and nobody had a paycheck, which meant nobody had money to pay their mortgages. So the government signed the CARES Act, which allowed people to put their mortgages on forbearance, meaning they put their mortgages on hold. And that's when lots of experts predicted that this was going to create a wave of foreclosures. We were going to see a tidal wave of foreclosures as soon as the forbearance program ends, because when it ends, then you're going to see millions of Americans exit the forbearance program, and then they're going to be hit with their mortgage payments and their penalties, and this is going to create a massive wave of foreclosures. And well, that wave never happened. For one, we saw home prices skyrocket. So even if you exited the mortgage forbearance program and you didn't have money to pay your mortgage, well, it wasn't that big of a deal, because you could just sell your home and walk away with a big profit, or you could refinance, or you had a number of different options because home prices had gone up so much. So there was no reason for you to go into foreclosure, because if you couldn't make your payments, you could just sell your home and walk away with a bunch of cash. And second, if you were a homeowner and you put your home into forbearance, you didn't have any direct cost of putting your home in forbearance. Like, you just had to apply and say, I want to put my home in forbearance. You didn't even have to show any hardship, and then you didn't have to pay your mortgage payments. And then when the forbearance program ended, well, all you had to do was start making your mortgage payments again. You didn't have to make any sort of lump sum payment. You didn't have to make up for your back payments. You didn't have to pay any extra interest. You just started paying your mortgage payments again as if nothing happened. I said that you as a homeowner didn't have to pay a direct cost, because there is a cost to people not paying their mortgages. Remember, these mortgages that were put on hold through the CARES Act were government-backed mortgages. So these are things like the FHA mortgages. And if they're government-backed, that means these agencies are not receiving any money. There's still a cost to running business. And so if this is a government-backed agency, FHA is a government-backed agency, and they're not making any money, who will support them? Well, none other than the United States government. And so if you have millions of homeowners that are not paying their mortgages, which should be going to a government-backed entity, and this government-backed entity is not making any money, well, then they will go to the government. And if the government doesn't have any money because the government is drowning in debt and they don't have money to pay their bills as it is, who are they going to go to? Well, none other than taxpayers and their tax dollars. It goes back to the regular people. So there was a cost to the mortgage forbearance program, but it was just passed on to taxpayers, and most people never even knew that happened, because no one really knows where the tax dollars are going. But now there's a new concern in the housing market, and this one has the potential to cause a lot more issues than the forbearance program, because the forbearance program really didn't come with any direct cost to the homeowner. The reason so many people are worried about the housing market is because everybody still has that looming fear of what happened in 2008 back in the back of their minds. Because in 2008, you had a big chunk of America that was underwater on their homes, and if you're underwater in your homes, that means you owe more debt than what the home is worth. And if you owe more money than what the home is worth, you can't sell it, because then you're going to have to come to the closing table with a whole bunch of cash. You can't refinance, because no bank is going to give you money on a home that you already owe more money than the home is worth on. And then you can't leave, because now if you're stuck, you can't make the monthly payments and you can't sell it and you can't refinance. Now you're stuck, and that's when the bank has no other option but to take the home away from you. So the number one thing that you want to pay attention to when it comes to the housing market, especially if you're worried about a housing market downturn, is equity. How much equity do people have in their homes? Because if people have equity in their homes, then you're not going to see a major crisis in the housing market, because if people have some sort of hardship, they can just sell their home for a profit. But if people don't have equity in their homes and they're underwater, well, then they won't have any options, and that's when you start to see a big uptick in foreclosures. And when you see more foreclosures, then you will see banks purchase properties and they'll just want to liquidate them, meaning they'll sell them at a discount, and this is what pushes home prices down. The concern that economists and Wall Street have now has to do directly with the Federal Reserve Bank, because the Federal Federal Reserve Bank is being forced to raise interest rates in 2022 to combat inflation. But the problem with raising interest rates is it is going to make it more expensive for somebody to go out and buy a home. Home price affordability is already at the lowest levels that we've ever seen. And now if you want to go out and buy a home, it is going to get more expensive in 2022, even if home prices don't go up, because it's going to cost you a lot more money to service your debt payments. It's going to cost you a lot more to make your monthly mortgage payments because interest payments are expected to go up quite a bit in 2022. That's why you see so many people from the Motley Fool to Forbes to NASDAQ trying to predict if we're going to see a housing market crash in 2022 due to the rising interest rates, because as it becomes more expensive for people to buy a home, less and less people will be able to buy a home. And if you have less people trying to buy homes, well, then that could create a dilemma in the housing market, because if somebody's trying to sell their home and nobody's buying it, then they're going to have to cut the price on their home to attract somebody to come and buy it. This is how supply and demand works. If you have more demand than supply, well, then these people are going to fight against each other to buy the limited supply of homes, which pushes home prices up. But if you have more supply than demand, and now you have a whole bunch of sellers that are trying to sell their home, but nobody wants to buy it, well, now the sellers have to compete against each other. And the way that they do that is by cutting prices. This is what we saw happen between 2008 and 2012, where sellers were trying to sell their home, but nobody wanted to buy it. That was a buyer's market. If you bought a home between 2008 and 2012, you probably got a massive bargain. But if you want to buy a home between 2021 and 2022, now you're competing against a whole bunch of people and you're not getting a bargain on a home, but you can still get a home with low interest rates. The thing that you really want to pay attention to is how much interest rates will rise. And we don't really have a definite answer on that, but that's going to determine how much more expensive it will be for you to go out and buy a home. Because if we see the Federal Reserve Bank raise interest rates significantly, meaning they raise it multiple times, well, that's going to really make housing less affordable. But if we only see a couple or a few interest rate hikes, well then yeah, that will make housing less affordable, but it's less drastic. And this is one of those things where unfortunately we're not going to know until we actually see what the Fed does. Like, I can say what we think the Fed should do, but what the Fed should do is different than what the Fed will actually do. Some polls say that the Federal Reserve Bank is going to raise interest rates 3 times in 2022. Some officials say that the Fed is going to raise interest rates 4 times, and then you have some bankers that say that the Fed is going to raise interest rates more than 4 times in 2022, and then you have some people saying that it's possible for the Fed to raise interest rates 7 times in 2022. See, the Fed kind of works like a magic act. They'll tell you what you need to be aware of, and they'll tell you some things that you want to pay attention to, but sometimes it's just a sleight of hand, and you're not actually going to know what the Fed is doing until they actually do it. That's why we don't know what the Fed is actually going to do until they announce it, and we can guess and we can predict, and the Fed might give us hints, but we really have no idea until the Fed has a meeting and then they tell us what we need to know, and that might be a surprise. It might be something we predict, but there's no way for us to know. Now, the easiest way for you to actually be on top of what the Fed is doing and know what they're doing as soon as they do it is just by subscribing to my Market Briefs newsletter. That's a free newsletter that will keep you up to date on exactly what's going on in the finance and business world, and you can read the newsletter in just a few minutes every morning. So if you want to join the Market Briefs newsletter, I'll put the link to where you can do that in the description below. The dilemma that the Fed is facing right now is that they need to raise interest rates in order to fight inflation, but the problem is if they raise interest rates, that's going to slow down the economy, because then it's going to become more expensive for you to go out and buy a home. And when we saw the Fed try to raise interest rates in 2021, we saw that home buying slowed down significantly because people didn't want to pay the higher interest rates. And so the Fed needs to raise interest rates. Inflation is getting out of control. It's becoming very hard for people to afford life. And so the Fed needs to raise interest rates because that's how they fight inflation. But if they start fighting inflation, that would hurt the economy. And if that hurts the economy, that means realtors won't be getting paid as much. Bankers won't be getting paid as much. Title companies won't be getting paid as much. Contractors won't be getting paid as much. Builders won't be getting paid as much. So that would slow down the economy, and that's the worry that the Federal Reserve Bank has. The reason that the Fed says that they're willing to raise interest rates is because the economy has been growing pretty significantly. We saw the economy boom in 2021 because people had a lot of cash in their pockets. People had cash because they weren't spending in 2020. They really just started to go out again in the middle part of 2021. So people had that pent-up demand, and they had the cash saved up because they didn't have as many expenses. And so now when the Fed is trying to debate what they should be doing to help support the economy, they want to fight inflation, but they also don't want to hurt the economy. See, the underlying problem is that inflation is getting really bad. The Fed was hoping that inflation would have completely gone away by the end of 2021. That's what they originally predicted. Now they're saying that it'll be gone by the end of 2022, but the way things are looking, it doesn't look like it's going to be slowing down at all in the end of 2022, which means it is going to become very expensive for average people to afford anything just because the prices of things are going up so much. And the reason why the prices of things are going up is not just because greedy business owners are raising the prices. It's because the value of the dollar that you're using to buy these items is dropping every time you see more inflation. And when you have lower interest rates, that creates more inflation because lower interest rates contribute to more lending. More lending means more dollar enter our economic circulation. And when we have more dollars in our economic circulation, that makes the value of each individual dollar that you have and the value of each individual dollar that you earn go down. That's why so many people who got a raise in 2021 are poorer now than they were before, just because the raise that you're getting at your job isn't enough to keep up with the higher inflation. I'm a money nerd, so I love studying historical financial trends, and the last time that we saw inflation this bad was back in the early 1980s. This was after a period of very high inflation in the 1970s, and in order to combat the inflation that we saw in the 70s and the 80s, the Fed had to significantly raise interest rates. If you wanted to go out and get a mortgage in 1982, it wasn't going to cost you 3 or 4 or 5% a year. A 30-year fixed rate mortgage was going to cost you somewhere between 15, 16, 17, and 18% a year in interest. The reason why the interest rates had to go so high was because that was the only way that the Fed could fight the growing inflation. We're already seeing the same inflation today that we saw back in 1982, and if the inflation that we're seeing today does not significantly slow down, well, then that might force the Federal Reserve Bank to significantly raise interest rates, which would make buying a home significantly more expensive. Like if you went out today and you borrowed $500,000 at 3.5% a year to go out and buy a home, it would cost you just over $2,200 a month to borrow that $500,000 at 3.5% a year. But if mortgage rates went up to just say 6%, which historically isn't even that high, it's a lot higher than what it is now, but historically it's not that much. If you went out and borrowed $500,000 at 6% a year, now your mortgage payments are going to jump up to $3,000 a month. That means you're going to be paying almost $800 more a month on the exact same home just because mortgage payments are a lot higher. That's an extra $10,000 a year, and over the course of a 30-year mortgage, that's an extra $300,000 that you're going to have to pay on the exact same home, on the exact same home price, just because you're buying the home at a higher mortgage rate. This is one of the reasons why so many people are trying to capitalize on the lower mortgage rates and the lower refinance rates before the Fed starts to hike interest rates, because that's going to make borrowing money more expensive. I know I've said this before, but I want to say it again. If you are shopping around to get a mortgage or a refinance, there's a couple things you want to be aware of. First, don't borrow more than you can afford. At the end of the day, you're going to have to pay the money back. So even if interest rates are cheap, you don't want to be over leveraged, because you don't want to start living paycheck to paycheck just because you could go out and borrow money at 3.5% a year. And second, if you are going to get a mortgage or a refinance, make sure you shop around, because some lenders are going to charge you so much more in fees and interest than other lenders on the exact same loan. And if you do want to shop around, it is so much easier to do that now than 10 years ago, because you can just use a mortgage comparison tool on the internet. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage or refinance rates at no charge to you. They have multiple lenders that compete on their marketplace, so that way you can compare great rates and pick the option that's best for you. The process is super simple. All you have to do is go onto their website and enter in a few pieces of information, which just takes a few minutes, and then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Their pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might be able to qualify for, I'll put the link to where you can do that with Credible in the description below. Credible does pick an advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I'll put the link to where you can do that with Credible in the description below. If you want to gauge how fast the Fed is going to raise interest rates, the thing that you want to pay attention to is how strong the economy is, because the Fed has said time and time again that the thing that they're paying attention to determine how fast and how much they're going to raise interest rates is how strong the economy is. They say things like, how full is unemployment and how well is our economy operating, because the Fed knows that once they start raising interest rates, it is going to slow down the economy. So the last thing that they want to do is slow down the economy when the economy is already slowing. And so we're entering a weird phase right now, because we're coming out of 2021, we're entering 2022, and in 2022, we're already starting to see the economy slow down a bit, because in 2021, people had a lot of money and they were spending this money. This spurred a bunch of business growth because people were spending like crazy. Prices of things kept going up, but people kept spending. They didn't really care. And so businesses kept making money, even though they had to raise the price of their products because of inflation. And now in 2022, people's bank accounts are getting depleted. And so they don't have the ability or the means to spend it the way that they did in 2021. So people are having to downsize. And now that people are downsizing, businesses are starting to feel the pinch. They're already starting to realize that they're not making as much money now as they did before. This was the worst January that we've seen in history. And so we're starting to see the economy already start to slow down. And at the same time, the Fed is having to really start to worry about inflation, because if they don't raise interest rates, then inflation might get out of hand, and that could create a dollar crisis. And so the Fed is trying to dance on fire here, trying to manage both. And what they might end up doing if they don't start managing the problems is they might create a double problem where you have an economic recession and you have an inflation crisis at the exact same time. And that would really create a problem, because if you see an economic slowdown, then the Fed would not have the ability to cut interest rates and stimulate the economy, which is what they've done in the past. Remember, in the 2008 crash, the Fed slashed interest rates and created stimulus. They created more inflation, and that was their way of stimulating the economy. We saw the same thing after the 2001 dot-com crash. We saw a cut in interest rates, and we saw stimulus by the government and the Federal Reserve Bank to help stimulate the economy. Well, now we're on the verge of entering a recession induced by inflation, and you cannot fight an inflationary induced recession by creating more inflation. Well, let me rephrase that a little bit. You shouldn't fight an inflationary induced recession by creating more inflation. That's not saying that you can't, because I guess technically the Fed could. Because if we started to see the economy slow down even more, and the Fed started to worry about unemployment, and the Fed started to worry about spending, and the Fed started to worry about business growth, and then they said, you know what, we are going to pause these interest rate hikes. This is possible. If they decide to do that, that would make the dollar crisis worse. And that would make housing prices go up even more, because then they would cut interest rates, maybe create more stimulus. And if that happens, well, then you would see a lot more inflation. You might help spur the economy in the short term, but you're going to see a bigger divide between the rich and the poor. And you would see housing prices really start to go up then, because the value of the dollar would really be dropping. Back in 2020, before anybody was worried about inflation, I started talking about how inflation would be a major problem in the future. Then in 2021, that's when we started to hear more concerns about inflation, and that's when the Fed said that inflation is transitory and there's nothing for you to worry about, and that's when I kept saying that this inflation is going to get worse. Then towards the end of 2021, that's when the Fed finally said that inflation is not transitory, and now here we are in the early part of 2022, when the Fed is still saying that this inflation is going to go away by the end of 2022. Now, I don't think that's going to happen. I don't see how we are going to get out of this inflation mess unless we start to see major changes by the Fed. I don't think that we're going to see the major changes by the Fed that we need to fight inflation, because that means that the Fed would have to significantly raise interest rates, and our economy doesn't look like it's strong enough to support these rising interest rates, because the Fed doesn't want to see a slowdown in the economy. And if the Fed does not want to see a slowdown in the economy, and they're not willing to raise interest rates, and if they reverse course and they start to cut interest rates, that is going to make the inflation problem worse. This is why you need to be aware of what's going on. Now, there is a chance that the Fed says, you know what, this inflation is getting out of hand. We really need to take care of it before it becomes a bigger problem. If that happens and we see 7 interest rate hikes in 2022, well, yeah, that would be good for the dollar, but it's not going to be so good for the housing market, because then people are going to be priced out of the housing market, and you would probably see housing prices go down, and you'll also see stock prices go down. But if the Fed decides not to do that and they say, you know what, screw it, inflation isn't that bad, it'll get better in 2023, we're just going to continue helping to support the economy, that's going to make a much bigger inflation problem, and that ultimately makes all the bubbles that there are even bigger. Because inflation is just pumping a whole bunch of hot air into the economic system because you're printing a whole bunch of cheap money, you're printing a whole bunch of dollars, and once people start to realize that these dollars are just pieces of paper, well then that's when people start to get concerned about the state of their wealth and their economic well-being, and that's when people might start ditching the dollar and buying other assets to protect their money, to protect their wealth, and to protect their economic well-being. What's up everybody? If you want to continue building your financial education, I linked a relevant video here that I think you'll love, and as an added bonus, I have a free guide on how you can start generating passive income that you can download and read for free. All you gotta do is click that button below. I hired a new accountant recently and he calls me up last week and he says, Jaspreet, what do you think about G-Wagons?